Okay, so as promised, here is our standard deduction presentation. Standard deduction is a fixed amount that is determined on filing status. In 2018, if you're married filing jointly, you have a $24,000 standard deduction, 18,000 head of household, single 12,000, married filing separately 12,000. Also, a qualifying widower status is $24,000. Your additional standard deduction. So you are allowed to take this additional amount add it to your basic standard deduction for each occurrence of the taxpayer or taxpayer's spouse being over 65 or over as of the end of the year, and or blind. So each occurrence of that. So if you are married filing joint and both over 65, your standard deduction would be 24,000 plus 1,300 plus 1,300. Now, if you're head of household and you're not over 65, nor are you blind, but your dependent is blind, your standard deduction is $18,000 because it's not what's the characteristics of the dependent, but of the taxpayer and their spouse. And again, the additional standard deduction for each occurrence of being blind for the taxpayer or spouse and or over 65 at the end of the year depends on if you're married or unmarried. Take a look at those examples in Chapter 6. The final weird thing or exception to a basic standard deduction, so this only affects that standard deduction amount. Additional standard deductions would still be calculated the same way, is if the taxpayer is claimed as a dependent, I apologize, it's not dependent, but dependent on another's tax return. So how do we determine their standard deduction? It's the greater of 1,050 or earned income plus 350. So you say 1,050 and compare it to earned income plus $350. But their standard deduction can never be greater than the single status standard deduction. Take a look at some examples. Sue is claimed on her parents' tax return as a qualifying child. Sue worked part-time and made $3,000 in 2018. Sue should probably file a tax return, right? So when she's filing her tax return, what is her standard deduction? Well, she doesn't say I'm single, it's 12,000. Why not? Because she could be claimed as a dependent on another person's tax return. So she computes her standard deduction by comparing 1,050 to 3,000 plus 350, her earned income of 3,000 plus 350, or 3,350. The greater of those two is her standard deduction. And as long as that computation is less than the 12,000 that is normally allowed for a single person, then she can claim 3,350 as her standard deduction. So let's see what happens. What if her income from her job was 13,000? What is her standard deduction? The greater of 1,050 or earned income plus 350. Well, her earned income is 13,000 plus 350. So right now it looks like her standard deduction is 13,350. Now, it'll be 12,000 because that computation can never cause her standard deduction to be more than what it normally is for a single person. Okay, so that is how standard deduction works. Remember, that is a deduction from AGI. You compute that and compare it to your itemized deduction amount, and the greater of those two is what is actually going to be deducted.